So going through some of the details on some of these different provisions that you've heard a lot about that came about as a result of the one big beautiful tax bill. We certainly covered a lot of highlights in previous episodes of this program over the course of the past few weeks. We're digging a little deeper into it, and particularly before the break, we were talking about that car loan deduction. It is the good side of it is that it is an additional deduction regardless of whether you itemize or not. You don't need to itemize your deductions. You can take the standard deduction and then get this deduction for the car loan interest on top of it. So that's kind of cool. The negative side is that it is only available if your income is below certain thresholds, $100,000 if you're single, $200,000 if it's a married return. If you're above that, it starts to phase out pretty quickly. $200 of that deduction phases out for every $1,000 you're above those limits. So it phases out pretty quickly. The other part of it is you got to buy the right car. It's got to be a passenger vehicle less than 14,000 pounds. It's got to be brand new, and it's got to be final assembly in the U.S. Only available for 25 through 28 tax years. And then the practicality of it, as we were saying before the break, in order to maximize the deduction, which is a $10,000 deduction, you'd need to borrow $125,000. You'd need to, borrow $125,000 at 8% in order to maximize out the deduction. Let me be very clear: there ain't no deduction worth borrowing $125,000 at 8%. So perhaps make sure you make a good decision on that if you're looking to try and maximize that deduction. I might hold off on maximizing that one. That might not make the best amount of sense to borrow $125,000 for a car. Perhaps there might be something a little bit more economical on that, particularly if you really do qualify for it and you're making less than $200,000 as a married couple. Yeah, you probably shouldn't have that kind of car in the first place. But anyway, I digress. Next up, no tax on tips. So this one, a lot of conversation about. Again, this one good for tax years 25, 26, 27, 28. It applies to you regardless of whether you are on a W-2 or whether you are 1099, whether you're getting sort of self-employment income. It requires you, of course, to report all your tips, which you kind of should be doing anyway, but probably most people don't. Those tips are still subject to FICA taxes, Medicare, Social Security tax. That alone is almost 8%, 7.65% specifically. If you provide specialized services, and this would include even a technician or a plumber or something like that, then no, if you get a tip, no, that you're going to have to pay full freight on that. The no tax on tips exception does not apply to that. The deduction. So once again, this is another deduction. The deduction is $12,500 per person. So if you're on a married return, you could actually get a deduction of $25,000 out of this. But again, you've got to have the right income. In this case, your income as a single person has got to be less than $150,000. If you're doing a joint return, it's got to be less than $300,000. If you're above that, then there's again a phase out for $100 for every $1,000 you are above the thresholds. By the way, as a side note, whenever you're kind of working these phase outs and how this all works, and if you're trying to take advantage of this stuff, please use some kind of a professional tax software or professional tax preparer, because if you're trying to do this by hand, you're probably going to mess it up. Because there's a lot of math involved and a lot of behind the scenes calculations. So just a little caveat there. Here's the real thing that you need to know. On this deduction for no tax on tips, it is completely disallowed if you file on a married filing separate basis. So be careful, that at the end of the day, that you don't lose it if you have that married filing separate tax status. Bottom line on this one, obviously, it'll work. It'll save folks money, assuming that they kind of fit the box, that they're not getting tipped in a specialized service type of capacity. that they realize that the tips are still going to be subject to the FICA taxes, the Medicare, and the Social Security, and got to report all of the tips in and of themselves. You're going to get a deduction for those tips, but you've got to make sure that you qualify from an income perspective. So again, some things to know when it comes to, hey, I get tip income and I'm not going to have to pay taxes on it. You got to make sure that you fit, once again, you got to fit the box in order to be eligible for this one. Same thing on the tax on overtime. So all of these are, again, tax years 25 to 28. And this one, the no tax on overtime, only applies if you're W-2, so not 1099 like the no tax on tips, and only applies if you are hourly. So note that that is a big distinction on this no tax on overtime. Of course, it's still going to be subject, this income may be income tax exempt, but it's still going to be subject to FICA taxes, the Medicare, Social Security. The deduction, just like the no tax on tips, the no tax on overtime, it's still a $12,500 deduction. If you're married filing joint, that $12,500 is per person, so you could go up to $25,000. Similar phase out, $100. You lose $100 for every $1,000 you're over that $150,000 limit as a single person, that $300,000 as a married filing joint. It is, just like the no tax on tips, disallowed if you are married filing separately. So make sure that you are aware of that limitation. It also, and interestingly, this is again where the calculation kind of gets wonky. This no tax on overtime only applies to the overtime portion of the wages. So let me give you an example on this. So let's say you make $20 an hour and you work 10 hours of overtime. So that 10 hours of overtime wages, 1.5. Now you're going to get $30 per hour for those 10 hours of overtime. The portion that is no tax is that extra amount, that extra $10, the overtime piece that you are earning, and not the entire amount. So again, if you're making $20 an hour and you do some overtime, and then for those overtime hours you get $30 an hour at your traditional 1.5 times for overtime, then it's only the half, if you will, the excess amount that is eligible for this no tax on overtime. Yes, if you're listening there and thinking, well, that's kind of very specific, that would be correct. These are not things that you can just kind of wave your hands at and all of a sudden you've got it all figured out. There's a lot of nuances in terms of how these things play out, particularly when you start to look at that no tax on overtime and the additional calculation you've got to make, because the no tax on overtime only applies to sort of the extra amount that you get on those hours that you work on an overtime basis. So just be aware of that. And then lastly, the Trump accounts, and we may have to circle back on this one. 25 to 28, got to be a U.S. citizen with a Social Security number. If you're for every newborn, it's $1,000 put into that account by the federal government. It has to be invested in basically index funds. That's the limitation on it. You can contribute up to $5,000. Your employer could also do $2,500. But here's the kicker. Those contributions are done on a post-tax basis. So you do not save any money when you make a contribution into a Trump account. More importantly, when the money gets used, and it looks and acts a little bit like a retirement account here, because you can't use the money before 59.5 without a 10% penalty. It's taxed at ordinary income tax rate. So just understand how it works. You put the money in post-tax, so after tax. So think that sounds like that's a Roth, right? Well, no. The Roth, you would get that money back tax-free. With the Trump account, when you get that money, you still have to pay taxes on it. So there is a lot of wrinkles when it comes to this Trump account. We're going to be talking more about it in greater depth on future shows, but just understand that that's how it works. The main incentive, look, take the personal savings component, the $1,000 that the federal government's going to give to that newborn if you have one between now and 2028. But I think there's better opportunities in terms of how to save your money. With that, we're going to get on out of here. This has been Dollars and Cents with Joel Garris of Nelson Financial Planning.